what if the company is selling more than one product? How do we go about it? So let's look at the same idea in a multiple product environment. So multiple products. Now, the only thing we have to be concerned about here is the calculation of the break-even point in value and then the break-even point in unit. So we're going to take it one after the other. Let's do first on the break-even point in value. In a multiple product environment, the break-even point in value is your fixed cost divided by weighted average contribution to sales ratio. Weighted average CS ratio. What does that mean? It means that in a multiple product environment, we have to calculate the weighted average CS ratio. It's simple. The weighted average CS ratio is simply your total contribution from all products in the question. So you calculate contribution for each of the products, then you add it together to get a total contribution for the company, divided by your total sales, again from all the products, certainly times 100. So let me bring this down a little bit so I can work my percentage. This is how we calculate weighted average contribution to sales ratio. Total contribution from all the products divided by total sales from all the products. Then you have your fixed cost. Then you can calculate the break-even point in value for the multiple product environment. Again, that break-even point in value will be for the entire organization or the entire company. So let me bring up an illustrative question here. Cardio co. So the A aspect of the question says, calculate the weighted average contribution to sales ratio for Cardio co. Then B says, calculate the margin of safety in dollar revenue for Cardio co. So let's go. First, weighted average contribution to sales ratio. So Cardio co. We just said that the weighted average contribution to sales ratio is total contribution from all the products divided by total sales from all the products times 100. Okay. So first, we need contribution from all the products. Then we need sales from all the products. So let me take it one after the other. Let me see if I can simplify our workflow a little bit. So first, let's get the sales coming up for the products. We see selling price, we see units. So we're going to multiply that up respectively to get a sales. 672,000, 1,008 by 400, 720,000, 1,004 by 380, 532,000. So we add the 3 up, and that gives us the total sales for the 3 products. And that is 192,400. Now, that total sales is the denominator because total sales from all the products. Now we need the numerator, total contribution from all the product. Now, let's look at the question here. It says, Labor costs are 60% fixed and 40% variable. So we need to work ourselves out to get a variable cost situation coming in here. So total or variable cost calculation. So T, C, and R. Material, let's bring material respectively. 430, 500, 360. That is material. Then we go to labor. Now the labor, they said 60% is fixed, 40% is variable. So we are interested in the 40% of the variable cost respectively. So that'll be 40% of 220, 240, 190. So 40% of these figures respectively. 88 here. 96 for the C. 190 will give us 76. So that is labor cost, the variable component. Then variable overheads. It's a variable cost. 110, 120, 95. We'll bring that up. $110, $120, $95. General fixed overheads excluding any fixed labor costs are expected to be $55,000 for the year. We'll come back to that in a moment. But for now, this gives us the total variable cost per unit. So 430, 88, 110, 628 here, 500, 96, 120, 716 here, 360, 76, 95, 531 there. So this is total variable cost per unit. Now, we can calculate contribution per unit, so we can calculate total contribution. So total contribution calculation. So we bring the selling price per unit as given in the question, 1,006, 1,008, 1,004. Then we can less the variable cost we just calculated. $628, $716, $531. And that is going to give us the contribution per unit. And respectively, that will be 1,004 minus my answer for the last one, 869 here, 1,008 minus 716, 1084, 1,006 by 628, 972. But we are interested in total contribution, not contribution per unit. So we now bring in the units. as given in the question respectively, 420, 400, 380. And then we multiply these up respectively to give us the contribution. So times 420, 408, 240 here. 1084 times 400, 433, 600. 869 by 380. Oh, I did plus. 869 by 380. That's 330, 220. So we add the 3 up to give us the total contribution. I think I need to go to the next slide. Which is 330, 220 plus 433, 600 plus 408, 240. And I'm getting 172,060. So this is our total contribution. Total contribution. Now, remember the A aspect of the question and what we are doing. It says calculate weighted average contribution to sales ratio. So all these that we are doing, we have our total sales now. We have our total contribution now. So we can calculate the weighted average contribution to sales ratio. Let me just pick the formula. And bring it up. So total contribution 1172 and 60 divided by total sales 1924,000 times 100. 1924,000 times 100, and I'm getting 60.92%. So that is how we calculate weighted average contribution to sales ratio. So yes, we need the sales for each of the products. Add it up, gives us the total sales for the entity. Then you need contribution for each of the products. Add it up, gives us total contribution for the entity. Then we can calculate the weighted average contribution to sales ratio. So that is the way we calculate weighted average to sales ratio. But look at the B aspect of the question. It says margin of safety. Okay, it's here. Margin of safety in revenue for cardio co. Now, margin of safety in revenue, how do we calculate that? Margin of safety in value is your budgeted sales minus break-even point in value. So, in order to calculate the margin of safety in value, we need the break-even point in value. So in a multiple product environment, how do we calculate break-even point in value? Again, we mentioned that earlier. We said in a multiple product environment, break-even point in value is your fixed cost over the weighted average contribution to sales ratio. There you go. Okay. Where is the fixed cost? It's not given directly in the question, so we have to calculate it because there are various elements of the fixed cost in the context of the question. So, fixed cost calculation. If you look at the question carefully, we are told that there is general overhead excluding any fixed labor cost, 55,000. But then the labor cost had a fixed component. So we need to calculate that quickly. So labor cost. The rule is that for each of the labor costs, 60% was fixed. So what do? You're going to take 60% of the labor cost and then bring them up and then get the units in that particular case. So let's see if I can do some magic here. Give me a moment. Let me pick the product like this and bring it into my slide. Then I will pick the labor issue here. The same thing, but this time around we'll do 60%. I'm still going to have my total column here. So 60% is fixed. So 60% of these respectively, 132, 60% of 240, 144, 60% of 190, 114. So this is the fixed cost of labor per unit. So we bring the units respectively, which are here, 420. Just let me bring them up. Good. We'll just realign. So we multiply up to get a total fixed cost in terms of the labor. This is 43,320. For C, 144 by 400. That's 57,600. 132 by 420. 55,440. So we add the 3 up, 57,600, 43,320. And that gives us 156 for the total labor fixed cost. 156,360. So that is how we calculate the fixed cost here. Then we can add the general fixed overheads, which was given in the question, to be 55,000, and that will give us the total fixed cost. So in this question, there is a lot to be desired. That is 211,360. So that is our total fixed cost. So this is also demonstrating that it is not all the time that we will be having the fixed cost given to us directly as we did in the first question, and then boom, you go away. Sometimes the context of the question will be structured in such a manner that we will have to derive the fixed cost. And in this case, the labor cost given, part was fixed, part was variable. The variable component was used in calculating the contribution to sales ratio. Then the fixed component is now being used so that we can calculate the break-even point in value. So now that we have our total fixed cost, we can now calculate the break-even point in value for the company as a whole. So break-even point in value is going to be your fixed cost, which we had here, 211,360, divided by your weighted average contribution to sales ratio, which was from the A aspect of the question, 60.92%. And that gives us the break-even point in value. So my answer divided by 0.692, and I'm getting an amount of 305,443. 211,360 divided by 0.692. Yeah. 305,4, maybe 34. That's our sales or break-even point in value. Now that we have the break-even point in value, we can now answer the question, which is margin of safety in sales, which is the requirement of the question. So our budgeted sales, which is the same as our total sales that we calculated earlier, from here, total sales, 1,924,000 minus 305,434. 1,924,000 minus 305,434. 1618566. So that is the calculation of the margin of safety. So again, the way the question was asked, it says margin of safety for Cardiaco. So we have to understand that they are in a multiple product environment. So for me to calculate margin of safety, I need break-even point. However, because it's a multiple product environment, I need to calculate the break-even point in value for multiple product environment, which is your fixed cost over the weighted average contribution to sales ratio. So the context of the question is directing how we work ourselves out. And that is how we calculate the break-even point in value in a multiple product environment.